We just got a geopolitical shock that most people are reacting to emotionally, but very few are actually analyzing correctly. A major move announced by Trump involving Venezuela, oil exports, and enforcement actions that pull the United States, China, and indirectly Japan into the same macro picture. And before you jump to conclusions, this is not about taking sides or predicting headlines. This is about understanding how shocks like this move through the financial system and why markets almost always respond the same way in the early stages. When events like this hit, the first instinct is fear. Risk comes off the table, capital moves defensively, crypto sells off. That part is not surprising and it's not new. What matters is not the initial reaction, but what comes next and why it happens every single time. Because history is very clear on this point. Geopolitical stress does not kill markets long term, but it almost always creates short-term dislocations that confuse retail and reward prepared capital. Here's the mistake most people make right away. They treat this as a crypto-specific problem. It's not. This is an energy shock layered on top of a liquidity problem, layered on top of a global power struggle. Crypto is downstream from all of that. XRP is downstream from all of that. If you don't understand the upstream forces, you'll misread every price move that follows. Start with oil. Oil is not just a commodity, it's a macro lever. It directly affects inflation, production costs, transportation, and geopolitical leverage. When oil flows are disrupted or controlled, markets don't wait to see how it plays out politely. They de-risk first and ask questions later. That's exactly what you're seeing now. Not panic, but precaution. And this is where people forget history. At the beginning of every major conflict over the last several years, crypto corrected sharply. Russia, Ukraine, Israel, Palestine, even earlier geopolitical escalations. Each time the narrative was the same: uncertainty, risk-off behavior, selling pressure. And each time the people who sold emotionally at the beginning regretted it later, because those same periods marked some of the best long-term entry points once the dust settled. That doesn't mean prices can't go lower from here. They can, and pretending otherwise is dishonest. But lower prices during macro stress are not signals of failure. They are signals of liquidity tightening temporarily. The system pulls back before it pushes forward again. What's happening with Venezuela fits that pattern perfectly. This is about oil, control of supply, and who gets to dictate terms in a changing global order. The United States does not want energy influence shifting toward rival blocs, especially when those blocs are actively working to reduce reliance on the dollar. China's growing involvement in South America is not accidental, and it's not being ignored. Venezuela becomes a pressure point because it sits at the intersection of energy, politics, and global trade routes. Markets don't need a war to react. They just need uncertainty, and uncertainty is exactly what causes short-term selling across risk assets, including crypto. That doesn't mean crypto is broken. It means crypto is behaving like every other risk asset behaves when liquidity tightens. This is where disciplined thinking matters. You don't analyze this by asking whether XRP is good or bad. You analyze it by asking what happens to liquidity when oil prices shift, when inflation expectations change, and when central banks are forced to respond. Crypto doesn't move in isolation. It moves when liquidity expands or contracts, and geopolitical events often accelerate that process in one direction before reversing it. So if you're feeling uneasy right now, that's normal. Markets are designed to make people uncomfortable during transitions, but discomfort does not equal danger. It often equals opportunity later, once the sequence plays out. The key is not reacting too early or assuming that the first move is the final move. To really understand what's happening right now, you have to step back and look at how markets have behaved during every major geopolitical disruption in recent years, because this isn't the first time we've seen this pattern, and it won't be the last. The mistake people keep making is assuming that each new conflict is different in a way that permanently breaks markets. History doesn't support that. Go back to the start of the Russia-Ukraine conflict. The initial reaction was brutal. Stocks sold off, crypto sold off harder. XRP, like most risk assets, took immediate downside pressure. The narrative at the time was fear-driven: war, instability, sanctions, uncertainty. Retail rushed to de-risk, convinced this was the beginning of a long-term collapse. But what actually happened after that first wave of selling tells you everything you need to know about how these events really work. Once the shock was absorbed, markets stabilized, liquidity adjusted, capital that had stepped to the sidelines started moving back in, and the people who quietly accumulated during that period while sentiment was at its worst ended up in a far stronger position than those who reacted emotionally at the start. The same thing played out during the Israel-Palestine escalation: short-term downside, heavy fear, aggressive headlines followed by normalization once markets processed the new information. This isn't optimism, it's pattern recognition. Geopolitical events create temporary liquidity stress. Investors don't suddenly decide assets are worthless. They decide they want flexibility. They move into cash. They move into perceived safety. They wait. And while they wait, prices fall. That's the window where opportunity forms, not because the situation is good, but because price no longer reflects long-term utility, only short-term fear. XRP has followed this exact script repeatedly. During the opening phase of conflict, it tends to correct alongside the broader market, not because something is wrong with XRP specifically, but because it's treated as a risk asset during periods of uncertainty. Correlations tighten, everything moves together, fundamentals don't matter in the moment, liquidity does. What separates experienced investors from emotional ones is understanding that this phase is transitional. It's not where trends are decided, it's where weak hands exit and strong hands prepare. Smart capital doesn't ask, how bad does this look right now? They ask, what will this look like after the market adapts? And this is where most people get shaken out. They assume the first reaction is the final outcome. They forget that markets are forward-looking systems. They price in fear early, often excessively, and then recalibrate once the situation becomes clearer. By the time certainty returns, prices have already moved. With Venezuela, oil, and global power dynamics now colliding, we're seeing the same early-stage behavior: risk-off positioning, selling pressure, anxiety. None of that tells you where the market will be 6 months from now. It tells you where it is right now, while uncertainty is highest. This is also why headlines feel louder at the beginning. Media amplifies fear because fear captures attention. But markets don't trade on headlines alone. They trade on flows, and once those flows stabilize, price follows. So the question is not whether XRP or crypto can drop further in the short term. They can. The real question is whether this event permanently damages the underlying system or whether it simply creates another liquidity reset before the next phase begins. History strongly favors the second outcome. Now, this is where most people completely lose the thread because they treat oil, inflation, interest rates, and crypto as separate stories. They're not. They're part of the same system. And if you don't understand how they connect, you'll misread both the downside and the recovery. Oil is one of the most powerful inputs in the global economy. It feeds directly into transportation costs, manufacturing, food prices, and ultimately inflation. When oil prices spike or when supply routes are disrupted, inflation expectations rise. When oil prices fall or stabilize, inflation pressure eases. That matters because central banks don't actually react to crypto, and they react to inflation and employment. Crypto just reacts after they do. Here's the chain reaction that almost always plays out. A geopolitical shock hits an energy producer or a key supply route. Markets sell risk assets because uncertainty rises. Oil initially becomes volatile. Then, if supply is constrained or demand weakens, oil prices stabilize or even fall. As oil prices come down, inflation data improves. And once inflation is under control, central banks have room to cut rates and reintroduce liquidity. That's the part most people miss. Short-term conflict often creates the conditions for longer-term easing. It feels backward emotionally, but it's how the system works. Lower oil prices reduce inflation. Lower inflation gives central banks cover to lower rates. Lower rates mean cheaper capital. And cheaper capital eventually finds its way back into risk assets, including crypto. This is why experienced investors don't just watch headlines, they watch macro indicators. They watch oil, they watch inflation prints, they watch employment data, and most importantly, they watch liquidity, because liquidity is the real driver of asset prices, not sentiment. When quantitative easing resumes or when rate cuts accelerate, capital doesn't stay parked forever. It flows, it looks for growth, it looks for asymmetry, and historically, crypto has been one of the biggest beneficiaries when liquidity expands, not because it's safe, but because it's highly sensitive to excess capital entering the system. XRP sits inside that same dynamic. When liquidity contracts, XRP sells off with everything else. When liquidity expands, XRP benefits disproportionately because it's already positioned as a bridge asset inside financial infrastructure discussions. It doesn't need retail excitement to move. It needs capital to flow. This is also why timing matters. Markets don't wait for policy announcements to react. They move when expectations shift. If investors believe rate cuts are coming, they start positioning before the first cut happens. If they believe liquidity is about to increase, they start reallocating while sentiment is still negative. That's how cycles actually turn. Right now, we're in the uncomfortable middle. Uncertainty is high, selling pressure exists, liquidity is tight. That's exactly when narratives feel darkest and conviction is lowest. But that phase doesn't last forever. It transitions once the data changes and once central banks are forced to respond. So when you hear people saying things have to get worse before they get better, that's not doom. That's mechanics. It's the system working through stress before resetting. The key is recognizing where you are in that sequence, not reacting as if the current moment is permanent. To really understand why this moment matters, you have to zoom out beyond Venezuela and oil and look at the broader power struggle that's been building for years. This isn't just about one country or one blockade. This is about who controls energy, who controls liquidity, and ultimately who controls the rules of the global financial system. China has been steadily expanding its influence across South America, Africa, and parts of Asia, especially through energy deals and long-term infrastructure investments. Venezuela sits right in the middle of that strategy. It's resource-rich, politically isolated, and willing to trade outside traditional U.S.-aligned systems. That makes it valuable to China and uncomfortable for the United States. So when you see the U.S. taking a hard stance here, it's not random, it's defensive. This is also where BRICS comes into the picture. The push toward alternative trade arrangements, local currency settlement, and gold-backed or commodity-linked systems is a direct challenge to dollar dominance. The United States doesn't need to lose a war to lose influence. It just needs global trade to slowly move away from the dollar. That's the real threat being addressed. Energy and money are inseparable in this fight. Control energy, and you influence inflation. Influence inflation, and you influence interest rates. Influence interest rates, and you control liquidity. That's why oil matters so much here. It's not just about fuel, it's about leverage. And when global leverage shifts, financial systems adapt. This is where neutral settlement infrastructure becomes important, not assets tied to one ideology or one nation, but systems that can move value efficiently between parties that don't fully trust each other. That's why during periods of geopolitical fragmentation, you tend to see renewed interest in settlement layers rather than speculative assets. This doesn't mean XRP suddenly becomes immune to volatility. It doesn't. In fact, during the early stages of these power struggles, XRP can experience just as much downside pressure as anything else. But structurally, it becomes more relevant, not less. Volatility shakes out weak positioning. Infrastructure relevance builds quietly underneath. What most people struggle with is holding both truths at once. Yes, prices can go lower in the short term, and yes, the long-term case can be strengthening at the same time. Those two things are not mutually exclusive. Markets often move in ways that punish impatience while rewarding preparation. The U.S. response to rising competition is not to abandon its financial system, it's to reinforce it. That means more liquidity tools, more monetary flexibility, and ultimately more pressure on central banks to support growth. That's why discussions around rate cuts, new Fed leadership, and aggressive easing keep resurfacing. They're not political noise, they're economic necessity. So while this moment feels chaotic, it's actually very revealing. It shows you where pressure points exist, how nations respond when dominance is challenged, and which systems are likely to be leaned on when things get unstable. Energy shocks expose weakness. Liquidity responses reveal priorities. And infrastructure gets stress tested in real time. So let's pull all of this together, because if you're only reacting to the headlines right now, you're missing the bigger picture entirely. What you're watching is not a single event. It's a sequence. Energy pressure, geopolitical tension, liquidity tightening, and then eventually policy response. Markets always move through that order, even though it feels chaotic when you're in the middle of it. Short term, it's completely reasonable to expect volatility. It's completely reasonable to expect fear-driven selling. And yes, it's completely possible that XRP and the broader crypto market see lower levels before things stabilize. Pretending otherwise doesn't make you smart, it just makes you unprepared. But lower prices during periods of macro stress are not signals that the system is broken. They're signals that liquidity is temporarily constrained. What actually determines the next major phase is not headlines out of Venezuela, not speculation about China, and not even short-term price action. It's liquidity. M2, interest rates, and central bank behavior are the real drivers. When inflation comes under control, when oil pressure eases, and when economic data forces central banks to respond, liquidity returns. And when liquidity returns, risk assets reprice. This is why timing matters more than emotion. Markets don't bottom when things feel good. They bottom when uncertainty is high, sentiment is washed out, and most people are convinced things will only get worse. That's not because the future is guaranteed to be bright, but because expectations are already pessimistic. And markets move on changes in expectations, not on absolute conditions. For XRP specifically, this is where discipline matters. XRP is not a trade that lives or dies on one geopolitical event. It's positioned around settlement, liquidity, and infrastructure, areas that become more important as the global system becomes more fragmented, not less. That doesn't protect it from short-term drawdowns, but it does explain why it keeps showing up in long-term conversations about payments, interoperability, and financial plumbing. The mistake most people make is trying to force certainty out of uncertainty. They want guarantees. They want exact timelines. They want someone to tell them the bottom is in or that the next move is up. Real markets don't work like that. The people who survive cycles are the ones who understand process, manage risk, and don't let fear or excitement dictate their decisions. And that's the mindset you need here. Calm, informed, patient, not blind optimism and not panic. Just awareness of where we are in the sequence and what actually drives the next phase. Before we wrap up, it's important to be absolutely clear. This content is for educational and informational purposes only. Nothing discussed here is financial advice. I am not telling you to buy, sell, or hold XRP or any other asset. You are responsible for doing your own research, understanding your own risk tolerance, and making your own financial decisions. Crypto markets are volatile and risky, and you should never invest money you cannot afford to lose. If you got value from this breakdown, take a moment to reflect rather than react. That alone puts you ahead of most people in this market. I'll continue breaking these situations down with context, not hype, so you can think clearly even when markets feel unstable.